Hello and welcome to the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Fred Bell, CEO of Elemental Altus Royalties, traded on the TSXV under the ticker ELE and on the OTCQX under the ticker ELEMF. And Fred, it's always great getting you on the show to get an update on Elemental Altus Royalties. We have had a lot of news come out since we've talked last, and it hasn't even been that long, but you've been very busy as a company. I want to kick things off with the news that you just released today, though, and that is recapping the operations from Q4, the Q4 revenue, and also a record 2023. This makes 6 successive years in a row of record revenue for the company, which I think is a pretty big milestone to have crossed. I don't think there's many companies in any sector, much less the mining sector, that can talk about 6 successive years in a row of record revenue growth. So let's maybe start there, Fred. Walk us through some of the key metrics on this report.
Thanks, Shad. Yes, this is the sixth year. Every year the company has been in existence, we have had increased revenue on the previous year. And I think one of the key parts of that as well is we're also in the background increasing the average mine life of those assets. So for 2023, we had a 70% increase in revenue on 2022. We've already said that we expect to increase that again for this year when we announce it. And that is a total of about approximately 17.8 million US revenue in 2023. And the Q4 number that was the highest quarter the company's ever had as well. That Q4 number was 5.6 million adjusted Q4 revenue. So from our perspective, we're really starting now to see some of the benefits of that growth in royalty revenue. And we're doing it alongside, at the same time, continuing to build out development portfolio as we go.
Well, Fred, you'd made an interesting comment to me off mic, and it's kind of following up on some previous discussions we've had just about the nature of how the company has changed over the last 2 or 3 years. So maybe summarize that for people listening in. Maybe they're just checking in for the first time on Elemental Altus. Maybe they were an Elemental shareholder or an Altus shareholder before the merger. But how is the company set up now financially and operationally with the new pro forma company after having gone through some of the combining and synergies, and now as you look ahead at 2024 and beyond?
It's a very good question, Chad, because we're in a point in the mining sector, and I think anyone who is involved and exposed to the mining sector knows that we're at a point where there is less interest in the space, equity valuations are depressed relative, and so being in a position of financial strength is critical. The company has never been in a stronger financial position. We'll have higher, every year has been a record in terms of revenue, but we're also going to have record margins this year from that revenue. So that will really drive free cash flow. And that was part of the fundamental reason we had the merger between Elemental and Altus towards the end. It closed in August 2022. And really through 22 into 23, what we did is we found some really high quality partners for some of the best projects, wholly owned projects that we owned. And we had a fairly unique situation in Mali in that we own two licenses, Diba and the Campfla, next to Sadiola, which for those who don't know, Allied Gold own it, now listed in North America, but it's a 10 million ounce mine. So it is an enormous mine. If it was in Canada or the US, everyone would call it straight away a tier one asset. And I think that Sadiola, we have oxide resource to the south of it, but we also have unexplored huge potential on the sulfide side. And we did a deal with Allied Gold at the end of last year when they listed to put that project into Allied. And they have announced, I think in the last week or two, that they'll be putting that into production in the next 2 weeks, revenue coming to us from H1 this year. So from our perspective, that's a great example of taking an asset that was costing us money and being able to transform it into actually an incredibly valuable royalty for us going forwards that is going to be a revenue center and has the potential to become a much larger royalty over time as they do exploration there. And so look at it on the big picture. We have really managed to reduce the costs since the merger. We had a lot of one-off costs at the merger when you put the companies together, but since then we have really reduced the costs. We have managed to bring in some very credible partners on the projects in Egypt. It's a private company, In2Metals, who is wholly owned by Naguib Sawiris, the principal at La Mancha, and they started drilling before the end of last year. So we'll have drill results coming out in Egypt, more than we could ever have done. In Mali, Allied committed to 12 kilometers of capital expenditure to get the haul road built to Diba to start drilling it out. They announced maiden reserves coming into production in H1 this year. The deal we did in Ethiopia with a well-known group in a private company there, they've been doing more work on the ground than we have. So I think in these cases, we are taking what have been previously costs and we are really trying to, I think, make it as efficient as possible and get as much cash flow as possible so that we can redeploy that cash flow into the market at a time when valuations are an all-time low. And I think we also announced in our press release today for the first time, starting to look at dividends as well as paying down some of the small amount of debt that we have too. So it really gives you optionality. And so I think we're starting to see that value come through from the merger.
Yeah, Fred, I'm glad you broke it down that way because we have gotten a lot of questions, and I think we've discussed this in prior calls, but just that people were questioning, well, what are you doing with optioning some of these projects out to partners? And I think now it's becoming more clear with the success that Allied's having in Mali or the deals that you did in Egypt and Ethiopia of why you did that, but it frees up the cash to do things like dividends, like paying down debt, and like doing other deals. Another thing you did in 2023 that's worth highlighting and maybe just get an update from you is you actually got a bigger chunk of the Caserones royalty. You upped your stake in it. That's the large copper projects down in South America that the Lundin Mining Group is operating. Can you give us an update there? Because it's just another example of how having better financials allows you to do more creative deals like this.
Very good example to use, Shad. And in our announcement today, we said that we had 6.1 million US dollars in attributable revenue from the Caserones royalty in 2023. And that is a royalty that I think Lundin just in early February actually put out a new resource estimate for it. And they increased the mineral resource there in measured and indicated by over 35%. So this was an asset that, in our view, already has an extremely long mine life, and in our view, it will be a generational large copper porphyry system in Chile that will go for many years. And so the ability to increase our exposure to that asset is for us giving us uncapped optionality on both copper and molybdenum production for many years going into the future. And as well as that new resource estimate that Lundin put out, which materially increases it, they also gave guidance for this year and 2025 and 2026. And for those who don't recall, Lundin recently acquired a majority stake in the Caserones mine last year, and they have started the first drilling in that royalty area since I think the mine commenced production in 2013. So from our perspective, to have an operator like the Lundins in and to have someone who's got the money and the ability and the track record to really explore is really exciting because as a royalty holder, again, we have optionality at no cost on all of these projects, and particularly at the big projects where there is really material exploration upside and assets like Caserones. I think great to see the operators coming in there and spending money to explore for future discoveries.
Yeah, Fred, I think this is such an important point, and I think sometimes it's lost when people do drive-by evaluations of royalty companies. They just look at the cash flowing assets, but they ignore that there's this discovery optionality, that there's the ability of these operators to come in and find new areas, find high-grade zones that they didn't know about before, go at depth, find satellite pits. There's all this potential on the royalties that are producing, but also on ones that are not yet producing. Another update you put out on the 29th of February, you were talking about the royalty you hold on Arizona Sonoran's copper project, their Cactus mine, and they just put out a pre-feasibility study outlining some of the economics on it. But that's a project we've followed on our show for a while where they keep growing it, keep finding more. You're not doing anything else as the royalty holder. You're just watching these operators grow and advance and de-risk these projects. So maybe speak to that value in the royalty business model.
Yes, and someone once, a fund manager in the mining space, once described it to me as option value. So in a similar way that you use Black-Scholes calculation to try and put a value on something inherently intangible. How do you value the exploration optionality and upside? Well, if you do a Black-Scholes option value on it, maybe that's a good way to do it. And I know that they did that when looking at particularly producing royalties, uncapped producing royalties. And it's why with some of the really high quality royalty assets, you've seen them going for as much as 2 times net asset value. And that's been the majors buying them. And the reason has been because they look at the asset and go, even though we only have a 10-year mine life or a 20-year mine life, we can see the potential for this asset to go for many decades beyond it. And we are capturing in this royalty, we are capturing exploration optionality, we're capturing price optionality because we don't really have exposure to inflation in the same way, and we have exposure to increase in commodity prices. We're capturing optionality on technology as mining technology, recovery technology improves. You have lots of cases of historical heap leaches that were by modern standards relatively high grade, and people can go back and recover more ounces or minerals from that. So you have all of these different pathways to optionality as a royalty holder at no cost. And so it is a really powerful instrument, and particularly on assets that have exploration upside. And you mentioned Cactus, and that's a very good example because I think they've got another PFS. They just came out with their PFS, but I think they're doing a PFS integrating Newton technology by the end of this year, and also a definitive feasibility study by the end of this year. So they are being very active in progressing that project. And from our side, again, it's great to see even in a difficult market, and there is no doubt that today's market is difficult. If you are not a high quality project, you cannot progress in today's market. So to have royalties on high quality projects that are continuing to progress and giving us lots of optionality and upside, that is what we are trying to build in and layer into the portfolio. And every year that goes by, we should have more money to redeploy into new royalties. And so it's been I think in our view, it's been a very disciplined and patient approach, and hopefully starting to pay dividends, maybe even literally as well as metaphorically going forwards.
Yes, it's paying dividends to the company in the broader sense, and it may be paying dividends to shareholders soon. So something to
Yeah.
definitely track. Well, you do have a lot of cash flowing royalty assets that are producing, but you do have a lot of royalties that are still in that development stage or exploration stage. Are there any other royalties that are not in production yet that you've got your eye on that are moving down the pipeline of de-risking their projects that you feel aren't getting noticed in your portfolio?
Yeah, there's definitely a few in there. I have always quite liked the Laverton project in Australia. It's owned by a company, partly owned by Shandong, Chinese entity. So it's got a sort of different strategic approach. But I think that in the right hands, that gold deposit, and it's in the midst of a few producers in Western Australia, there's an awful lot of potential in that ground there. And part of the royalty covers the old historical Lancefield underground mine. And in Western Australia in the 1990s, it was one of the top 10 underground gold mines. So, having royalties on like that, and we also have a royalty on the Pickle Crow asset in Canada, which is, I think, one of the highest grade former operating gold mines in Canada. So there's a few assets like that where they're multi-million ounce or multi-million ounce potential assets, and we have royalties over them. And I think we feel very comfortable owning those because we know that we are exposed to huge optionality and leverage moving forwards. And again, our holding cost is zero to minimal.
Well, and Fred, in addition to some of these growth areas of the company, whether they're from the production growth or the royalties that you have on operating mines getting into juicier parts of the deposits, there's also the optionality that a royalty company has in just doing one-off transactions. And there's a big one you just announced later in February, and that was the 12 million in payments from the sale of the Ming property. But you also announced in that press release that this contributes to $20 million US in one-off payments the company expects to receive across the portfolio over the next year or so. So maybe talk to us about some of the optionality you have in doing one-off transactions like this, and in particular, give people an update on Ming because everybody has been watching that asset in the portfolio for some time.
Yes, Ming's a very good, I think it's a very good case study in an investment that actually didn't fit our initial thesis, but you end up coming out of it with more than you put in. And so even though your investment thesis doesn't play out, you have enough downside risk protection that you actually still make a profit on it. So we invested, I think, $11 million in that in 2022, and we will receive by April 2025, we'll probably get in the order of about 13 million US back, plus or minus. And so that actually, from an investment perspective, was, and our thesis was not correct. And yet we come out of it well because we had a fully secured stream over the asset. And so that's been helpful for us to get clarity on. And I think we have known in the background it's been progressing, but we just haven't been able to perhaps put out an announcement with all the details until they were confirmed. But that's pretty material for us because it contributes to an additional approximately 20 million US dollars that we will get in over the course of 2024 and 2025 from a mixture of one-off payments on some of the assets, some payments linked to production, one or two payments linked to the ability to buy back part of royalties on some of the non-producing assets, where they have a deadline, so they have to be bought back by that date. But all in, it probably brings in another $20 million plus to us over this year and next year, which is what gives us an incredible ability to deploy capital. And if you're looking at us and looking at this at a high level, I think we had call it 150 million US dollar market cap as of yesterday, and we should have approximately 50 million US dollars to deploy across 2024 and 2025 without needing to raise any more money. And so that is a better position than we have ever been in as a company. We're in a stronger financial position than we've ever been in as a company. And that is happening at a time where the mining space is at a cyclical low and there is historically low amounts of capital available. So that is the scenario where royalty companies tend to be very well positioned. And I think for us, being a very cash positive, cash generative royalty company in a difficult market, that's our unique strength.
Yeah, Fred, it's nice to be cashed up in the precious metals and base metal space right now when so many companies are cash starved. It brings up the question if you're looking at future transactions. I know that your team is always very selective in the ones that you may acquire, but are you considering at all using the cash flow that you have and the cash reserves to partner with companies that need that cash to advance a project to create a royalty? Are you looking at royalty generation?
Absolutely. Yeah, both. I mean, we're looking both to create royalties and streams with operators themselves, as well as buying existing ones. And I think that there's probably a different market for both. I would probably go back and say in 2021, 2020, maybe 2021, there was more capital available for a lot of the operators, developers, explorers, and they didn't need a royalty company as much. And I think that in today's market, the prime consideration for a lot of companies is we're in a downturn, limit dilution to shareholders, try and protect that capital structure. And so I think all of a sudden, royalties and streams, sort of joint ventures at an asset level, those sort of non-dilutionary transactions become an awful lot more attractive.
Well, Fred, just as we wrap up, I guess just any parting ideas that you want to share with investors looking at the royalty space, looking at Elemental Altus Royalties in your peer group, what are any other areas you want to point to as far as news flow or distinguishing areas for the company that you think investors should know?
Look, I think we will have our guidance out shortly for 2024. And I think that should be a really good update and on where we stand, both in terms of we're expecting record revenue again this year, but also for the first time, probably in the company's history, being presented with a choice on what to do with our capital. And I can take people back to when we started Elemental and it was under $1 million fundraise for our first fundraise. 967,500 was the precise amount. And if I look at it today, and we're talking about probably, Q4 was $5.5 million in terms of revenue. It gives you an idea for how much we've grown, and that opens up a whole wealth of possibilities going forward. So I think that we'll continue to be active in acquiring new royalties, but also potentially the ability to start talking about paying down some debt and also looking at a dividend going forwards, which historically we haven't done. So I think that will be probably another moment for the company to sort of tick the box in terms of maturing.
Well, Fred, we'll wrap it up there, but it has been nice to watch the journey your company has been on over the last couple of years and that maturing process going from few cash flowing royalties to more and more cash flowing royalties to a bigger development pipeline to a bigger exploration pipeline, some optionality and some discoveries on some other properties, some one-off transactions, and now enough cash that you got some choices. You could do some deals, you could pay down some debt, you could create some dividend payments to shareholders. You've got that optionality. If people want to follow along with Elemental Altus Royalties and their news, definitely click on the link below this interview. It takes you over to the company website and their news section so you can see that 2024 guidance when it comes out. And Fred, looking forward to our next conversation.
Brilliant, Shad. Many thanks.